Let me start by asking a question that sounds almost ridiculous. What if a prolonged war in the Middle East actually ended up supporting Florida real estate demand? Not because war is good for the economy, it's not, but because when global uncertainty rises, capital behaves in very predictable ways. Money looks for safety, currencies move, energy prices spike, and investors start asking a simple question. Where in the world is my money safest? Today we're going to walk through that chain reaction step by step. First, we'll look at the global economy ripple effects if the Iran war persists. Then in part 2, we'll look at a counterintuitive scenario, why that same conflict could actually increase demand for Florida real estate, especially among Canadian investors. Part 1. If the Iran war persists, likely economic ripple effects. Iran's current strategy, according to many analysts, is not necessarily to defeat the United States militarily. It's something different. The strategy is to raise the economic cost of the war. And the way to do that is by targeting the global economy's pressure points. The biggest one is energy. Energy shock. About 20% of the world's oil and LNG, natural gas, shipments normally pass through the Strait of Hormuz. If that shipping lane becomes disrupted, even partially, global oil prices respond almost immediately. And oil is not just about gasoline. Oil affects transportation, agriculture, plastics, airlines, logistics, manufacturing, construction materials. In other words, oil is embedded in almost everything we buy. So when energy prices spike, inflation tends to follow. Shipping and trade disruptions. Energy is only part of the equation. Shipping routes through the Persian Gulf become riskier during conflict. When that happens, shipping insurance costs rise, cargo routes are rerouted, delivery times lengthen, freight costs increase. The result is supply chain friction. And that friction raises the price of physical goods around the world. Inflation returns. Energy shocks historically reignite inflation. And when inflation rises, central banks usually respond cautiously. Instead of cutting interest rates, they tend to keep rates higher for longer. That affects mortgage rates, business loans, construction financing, investment activity. In other words, a prolonged conflict could keep global financial conditions tight. Currency effects. During geopolitical crises, investors tend to move toward what are considered safe haven assets. This is called the flight to safety. The biggest safe haven asset in the world is still the US dollar. So during periods of uncertainty, global capital flows into US Treasury bonds. Investors hold more US dollars. The dollar often strengthens relative to other currencies. That has consequences for other economies. How about Canada's economy? Canada sits in an interesting position during energy shocks. Canada is a major oil exporter, which means higher oil prices can benefit the country's trade balance. Energy provinces like Alberta often see stronger revenues and investment. But Canadian consumers still feel the pain of higher fuel costs. So Canada can experience a strange combination of stronger energy exports, higher domestic inflation, slower consumer spending. Meanwhile, if the US dollar strengthens globally, the Canadian dollar often weakens slightly in comparison. That matters for Canadian investors looking south. How about the US economy? While the US produces a lot of energy, it's still highly sensitive to oil prices. Higher oil prices raise transportation costs, airline tickets, manufacturing inputs, food prices. When households spend more on energy, they tend to spend less on discretionary purchases. That creates a mild stagflation risk, slower growth combined with persistent inflation. The Federal Reserve may then delay interest rate cuts, and that keeps borrowing costs elevated. US real estate. Higher borrowing costs affect housing markets. The typical pattern is not an immediate price collapse. Instead, what tends to happen is transaction volumes fall, buyers hesitate, sales cycles lengthen. Housing supply in many US markets is still limited, which tends to slow price declines. But higher rates reduce affordability. How about Florida real estate? Florida has become quite unique in economic dynamics. The state continues to benefit from population migration, favorable tax policies, tourism, and service industries. However, inflation raises the cost of construction materials, insurance, and labor. That affects new development, renovation costs, operating expenses for property owners. How about Orlando real estate? Orlando's housing market is influenced heavily by population growth, tourism employment, service sector expansion, new multifamily construction. If interest rates remain elevated, home sales slow, rent growth moderates, occupancy remains relatively stable. Rental demand often stays strong because higher mortgage rates keep some households renting longer. Now, what about local service businesses? Businesses that rely on discretionary spending, like home remodeling, tend to feel the pressure first. Consumers become more cautious. Typical changes include longer decision times, increased price sensitivity, smaller project scopes. But renovation demand rarely disappears completely. Homeowners still renovate when kitchens fail, appliances break, or properties need updating. Successful businesses during inflationary periods tend to focus on value, durability, and predictable pricing. Part 2. The counterintuitive scenario for Orlando. Now here's where things get interesting, because the global chain reaction we just discussed can produce a surprising side effect. A prolonged Middle East conflict could actually increase demand for Florida real estate. That sounds strange at first, but the mechanism is fairly straightforward. The global safety trade. During geopolitical crises, investors often look for places where their wealth feels safer. That usually means 3 things: stable currencies, strong property rights, liquid real estate markets. The United States checks all 3 boxes, and Florida happens to be one of the easiest entry points for international buyers. The currency hedge. If the US dollar strengthens during global uncertainty, international investors sometimes move capital into US dollar denominated assets. Real estate is one of the most common choices. Why? Because property can act as both an investment and a lifestyle asset. Florida offers something few markets can combine: warm climate, relatively favorable taxes, international accessibility, strong tourism demand. What's Canada's role in all this? For Canadian investors, currency movements can make this dynamic even more interesting. If the US dollar strengthens relative to the Canadian dollar, some investors become cautious. But wealthier investors often react differently. They view US assets as a currency diversification strategy. Owning property in Florida effectively places part of their wealth inside the US economic system. That can feel like a form of financial insurance. What this means for Canadian Snowbird investors. So what does all of this mean if you're a Canadian investor looking at Florida? First, understand that global conflicts affect markets through indirect economic channels: energy prices, interest rates, currency movements, capital flows. Those forces can tighten financial conditions globally, but they can also reinforce the attractiveness of stable jurisdictions with strong property rights. Florida has historically been one of those destinations, especially for Canadians seeking lifestyle diversification, currency diversification, long-term real estate exposure. A prolonged geopolitical conflict does not automatically mean Florida real estate weakens. In some scenarios, it may even reinforce international demand. Because when uncertainty rises, investors around the world start asking the same question: where should part of my life and my capital live? For many Canadian Snowbird investors, Florida continues to be one of the answers. If you're a Canadian considering Florida real estate, the key is not to focus only on headlines. Instead, pay attention to the deeper economic forces, energy markets, currency movements, interest rates, and migration trends, because those forces often shape the real estate landscape far more than the headlines themselves.